In today's time, we all are talking about investing in the stock market, and it has almost become a very normal part of our life. Be it the headlines of newspapers covering the stock market crash, or the news channel recommending the next multi-bagger stock that will change your life. But do you know how it really originated? Well, it goes back up to 16th century. In the 1600s, the Dutch East India Company employed hundreds of ships to trade gold, porcelain, spices and silks around the world. But running this massive operation was not that cheap. In order to fund their expensive voyages, the company turned to private citizens, individuals who could invest money to support the trip in exchange for a share of the ship's profits. This practice allowed the company to afford even grander voyages, increasing profits for both themselves and their savvy investors. Selling these shares in coffee houses and shipping ports across the continent, the Dutch East India Company unknowingly invented the world's first stock market. Since then, companies have been collecting funds from willing investors to support all kind of businesses. And today, the stock market has schools, careers, and even whole television channels dedicated to understanding it. But the modern stock market is significantly more complicated than its original incarnation. So, how do companies and investors use the market today? Let's imagine a new shoes company that decides to launch on the market today. First, the company will advertise itself to big investors, private investors. If they think company is a good idea, they get the first crack at investing in that company and then sponsor the company's initial public offering or IPO. This launches the company onto the official public market where any company or individual like us who believes the business could be profitable might buy our stock. Buying stocks make those investors partial owners in the business. Their investment helps the company to grow, and as it becomes more successful, more buyers may see potential and start buying stock. As demand for those stock increases, so does their price, increasing the price for future prospective buyers and increasing the value of the company's stocks people already own. For the company, this increased interest helps fund new initiatives and also boosts its overall market value by showing how many people are willing to invest in their idea. For example, if Joseph owns a painting of a great artist, which everyone thinks will be worth much more in the future, then they will try to entice Joseph with higher price for the painting. And the bid war starts where everyone is willing to give more and more price for it. And hence the painting's price goes for the upward ride and hence increasing the market value of the painting. Same applies for the company. However, if for some reason a company starts to seem less profitable, the reverse can also happen. If investors think their stock value is going to decline, they will sell their stocks with the hopes of making profit before the company loses more value. As stocks are sold and demands for the stock goes down, the stock price falls, and with it, the company's market value. This can leave investors with big losses unless the company starts to look profitable again. This seesaw of supply and demand is influenced by many factors. Companies are under the unavoidable influence of market forces, such as the fluctuating price of materials, changes in production technology, and the shifting cost of labor. Investors may also be worried about changes in leadership, bad publicity, or larger factors like new laws and trade policies. All these variables cause day-to-day noise in the market, which can make companies appear more and less successful. And in the stock market, appearing to lose value often leads to losing investors, and in turn, losing actual value. Human confidence in the market has the power to trigger everything from economic boons to financial crisis. And this difficult to track variable is why most professionals promote reliable long-term investing over trying to make quick cash. It's much easier to rely on the calculated data of the company rather than on the emotions of other investors. However, experts are constantly building tools in efforts to increase their chance of success in this highly unpredictable system. But the stock market is not just for the rich and powerful. With the dawn of the internet, everyday investor can buy stocks in many of the exact same ways a large investor would. And as more people educate themselves about this complex system, they too can trade stocks, support the businesses they believe in, and pursue their financial goals. Like which coffee place you go to with your friends, you can invest there. Or the video games you play the most, invest in that company. Absolutely not. If you do your thorough analysis and invest for long term without worrying about day to day price of the company, then investing is totally logical and a great way to make sure that your money works for you. Remember, very few of us can earn this much of bulk money that the earned money would be sufficient to take care of us today and after retirement. Very few of us will be earning this much. So that is why investing is the utmost priority in your finance life. Warren Buffett is the best inspiration for that. He became one of the richest people on planet just by investing sensibly and sailing through the high tide. If you want to see his journey, then check out his movie on my channel. Link will be down below in the description. If you want to see a normal person's investing journey, then you can check out my portfolio update where I invest regularly and openly show what I'm doing with my portfolio. With that, I will take your leave. Press the like button if you love the video and subscribe to the channel to stay with me in this beautiful journey of achieving financial independence. My Money Universe.